Hello folks, welcome to Pro Trader Strategies. My name is Eric Wilkinson and this is a webinar on swing trades and using options around those swing trades that we find. So I'm going to dig into this strategy, but before I get into that, I really want to talk a little bit more about what we're going to be looking at with swing trades using options. Now, if you've gone back in time and watched all of these videos up until this point, you know that we started out with high volatility or bullish moves, bearish moves. And now it's like we're looking at something where we just don't have a full grasp on whether it's going to pop or drop based on a couple of different scenarios that are going on. So I'm going to talk about a scenario that I'm looking at, but we've all come to that conundrum where it's been a bit of a toss-up as to whether we think it's going to pop or drop. One of the things is we're pretty sure that it's not going to stay right here. So I'll talk about the levers and pulleys that go into this specific strategy, but just know we're doing the pop and drop and we got a great strategy for a particular underlying that I found fits pretty good. All right, so with this, we are going to be doing swing trades. How do we swing trade? Well, I'm going to go over that in just a moment, but we're eventually going to get to the long strangle. Now, I know, folks, you don't go out every day and think, God, I need to put on a long strangle today and try and find that opportunity. That's not really how I want to build this webinar. What I want to do is kind of build from simple concepts to real life examples. And in that, we'll go through the process as if it were like a daily occurrence, and then finding that opportunity, narrowing it down to the best option strategy for that underlying. All right, so that's what I'm going to try to do. Before you go, though, make sure you folks hit that subscribe button. Right next to it's a little bell. Sometimes in the mornings I do spot the trades where I pop in whenever I spot that trade. So you're going to have that notification in order to participate live with that. And throughout this video, please comment, folks. I want to make sure that you guys are clear concept. If I say something, misspeak or something, throw it over there. Make sure you send out the alarms. Because for one, if you have a question, somebody else probably has that same question and just isn't reaching out. So please feel free to reach out at any given time and smash that like button to feed those bots. We're trying to feed those bots to go out and find some more folks that look like you in order to share this video with. All right, first off, we need to talk about swing trades, right? And what is a swing trade? Ultimately, a swing trade is just basing a trade off of a momentum shift. And now we're going to dig into how we find those momentum shifts here in a little bit, but let's go down to real basic bones here. The first thing we're going to be looking at is an overall market, right? And we can see that a trend will be bullish, market neutral, or bearish, right? Those are the three kinds of markets we can have, folks. And then we'll kind of squint our eyes and look at this underlying and see what it's doing throughout the time of this underlying. So you'll see that the bottoms don't always hit, but we're looking at the overall trend here. And once we've determined that overall trend, we need to find where it loses momentum to the upside or gains support to the downside. So we're just going to try and draw some lines that hit the most of the tops. Some of those are going to break through, all right? So we're just trying to find the overarching support and resistance, trying to get as many of those tops as you can. You can make another line in the sand where it's a little bit wider if you wanted, say, for instance, just to hit some of those outliers, okay? If you have a weaker your lower risk tolerance, I should say, or you're newer to trading options, then maybe you go with that outside line there to start basing some of your first trades on to get used to it, okay? And then as your risk tolerance gets a little bit higher, meaning you are willing to add more risk, then take a look at those nearer support and resistance lines. So we've gotten our overall trend. We found the support and resistances now. Now we need to base our trade off of the pattern, which is in this case, we have a bearish pattern happening inside of a bullish trend, all right? We are basing it on the overall trend. This is a swing trade that we would be basing it off of this momentum shift, all right? And that momentum shift. So we've got a bearish with a bullish, bullish with a bearish, and a market neutral with a bearish. we're going to be looking for the pop and drop. So what we are looking for is maybe an underlying that's kind of moved up to another level and is ready to make a move. It could be based on your economic outlook and anything like that, or even that specific underlying. We probably should have played something like this with IBM. No, we shouldn't have. Why? Because IBM had too high implied volatility, right? So with this one, we'll talk about why the whys and why nots, when, where, and why, and ultimately how. All right. So in this case, what we're looking at is SPY. This is a bit of an older picture of it. But what we're looking at there is with the bullish trend, and I thought I had my pen lit up. We've got a bullish overall trend we can see here, right? That's a bullish overall trend. And then you can squint your eyes to find these support and resistance areas. You can see what I did. I just tried to hit a couple of them on the way up. Now, a lower risk tolerant person might want to look at this line. A person that has a higher risk tolerance might draw a line in here to hit those tops, okay? That would be adding a little bit more risk profile to these trades. If you were to lower or squeeze in that to make it a little bit tighter. And we found the support here. We can see what the overall trend is going in here. We talked about that being bullish, right? And then what we're looking at right here is the move on that bullish pattern reversal, right? That would be something we're looking for. So in swing trades, the thing we really like to look for are candles that look like that. That's a hammer. It could be like a spinning top where it has a little bit of the wick hanging out the bottom here, right? A long wick on the top, relatively smaller base. And it could be the flip side where you have the dojis, very similar in nature like that. So those are the key ones, all held in and of themselves. Those are set up candles. Now, folks, they can be red or blue. It doesn't matter. We're looking for that kind of shape, if you will, for the underlying or for the change in pattern. So, you know, you could have the same thing where you had a green one that looked like that, right? Or the top, spinning top, you know, flipped upside down, looking like that. So those are keys that we're looking for. Another one you can look for, it's very rare, and that is that tombstone doji, and it could be red again or green. All right. So with that said, those are the things we're looking for. We can see we got one of those little dojis right there at the bottom of a move, and then we got that confirmation. So that's usually what you're going to look for. Again, if you have a lower risk tolerant appetite, if you will, or a higher risk tolerant person, if a lower risk tolerant person would likely be looking at this candle for confirmation after the setup candles that we talked about. We are looking for those setup candles and then confirmation. In this case, a bottoming, we would look for a confirmation for the move to the upside, all right? Or here, look for that confirmation right next to it. So that pattern there, in a sense. It could be red or green. So we're looking for that pattern change. Again, market neutral. Here we have a market neutral trend, right? Where it is moving straight sideways. So we can see that this is market neutral going sideways. Again, kind of squint your eyes and figure out where the lines in the sand are going to be, right? And then we're going to look for the pattern reversal. So we got market neutral. You can draw your lines in there to try and hit those tops, hit the bottoms like that. I've got my Fibonacci's in here. You can do that. I'm not going to go through the whole setup on figuring out how to put on your Fibonacci's. I have videos on that, you guys. So make sure you guys are subscribing to our channel. Go check it out. There's all kinds of videos out there that are a little bit smaller segment than these longer webinars so that you can have a little bit of a refresher and things like that. So make sure you guys hit that subscribe button over there and that little bell to participate. And again, here we have a topping pattern. A more aggressive trader would probably set up a bearish trade around this, okay? And all the levers and pulleys we talk about, the guidelines that you should follow in these videos is what would determine the type of strategy for this type of bearish pattern, okay? It's really going to be dependent on the premiums and if they are cheap or expensive. That determines whether we're buying or selling option strategies. Buy low, sell high. I'll show you in just a moment how to figure out if these premiums are expensive or are they cheap, okay? In this case, during this whole time we were trading IBM, and we were doing strategies around this neutral trade. As a matter of fact, this is a really old snapshot of this. We have come back down. IBM, I talk about this all the time. This is the underlying that I got started trading options. I owned the stock in my portfolio, this in Walmart. And both these stocks were trading sideways back in the day. So I was doing covered calls against it back in the 90s, folks. Yeah, back in 1990s. All right. IBM was trading basically between 90 and 100. Now, they might have done a stock split since those last 20 years, but at the end of the day, IBM really doesn't go anywhere. So if you are getting involved in trading options, maybe look to do some covered call strategies around IBM, or getting your feet wet in trading stocks, especially from the short end, selling puts, selling calls, to do that collection of premium. One of the great things is if it gets put to you from selling the puts or it gets called away and you're short, well, this underlying really doesn't go a whole lot. It does not blast out too far. As a matter of fact, they can have good earnings like they just did and drop right back down. The street hates IBM for them trying to change their business structure. So anyway, playing this to the downside in our spotting the trades, I was selling calls because we had really high implied volatility in this particular underlying. So we were looking to sell calls in this trade. And we have, again, so we've done our bullish trend, our market neutral trend, and now we have an overall bearish trend with no support and resistances on here. So the reason why is because if you were an aggressive trader, it would be along those lines, right? And if you were not as aggressive of a trader, it would probably be further outside in that area, okay? Less opportunities when you're going further away, but usually those further away lines are the ones that hold more often, all right? Because it really what happens is it gets outside of this trend and there's another trend channel outside of that. It gets stuck on that second resistance area. Okay, but what happens? Yes, sometimes these things do go wrong. Once you've identified the overall trend, we've got a trend, we've got the resistance area up here that we know, we can see has worked before. One of the things, beauty, I'm getting a little ahead of myself here, is these strategies. Look how many times it comes up, and I'm looking at just this red line, how many times it comes up and gets close to it. Those are all opportunities with options that we can layer on different option strategies because we're having less risk. All right. When you do this as a long or a short with the underlying, folks, you only have a 50-50 shot of being right once you put it on. That's the probabilities of this underlying moving. The other thing is to have it come up and actually clip your resistance area doesn't always happen. So the theory is it needs to happen in order to do those pattern shifts if you are doing the outright or the future. If you're using the gold future or ETF, or not necessarily the ETF, but the futures, don't always come up and hit that. And when we talk about it with options, is that gives us opportunity to get further away from where the underlying is. So we don't always have to be perfectly right. And it gives us the opportunity to get involved more often. And if you are involved more often, then you have the probabilities moving in your favor. If you only do it like throw a dart one time at IBM and be like, all right, well, this is the great setup time, that's when I'm going to do it. No, not necessarily. We want to make sure all the levers and pulleys are in place. An aggressive trader, like I said, might get involved on this around that type of pattern. You got to be aware of the earnings, and you can see that would not have worked out very well. It never got confirmed. So the person that was Waiting for the confirmation would have never put on a trade in IBM. The aggressive trader might have, especially if you were in this as a stock, if you were shorting this stock, as soon as it blew above this wick, which is what anybody should be really doing as a newer trader for swing, it goes above that setup candle, which we said was that red one. That break above there and settlement above there means the pattern's broken. Get out, pull your ripcord, forget about it. Move on, come back maybe when it settles back down into that trend channel again, like it's, you'd wait for that kind of move. Here is another one. A lot of times when you get this setup candle and then it gets broken, you will see very shortly thereafter another setup candle. That's probably going to be the one that works, and that's probably going to be the one, if you got involved, pulled the ripcord, saw it set up again, you're going to be a little bit of gun shy, all right? Don't think about it as making money or losing money. If you're doing that, you are already failing, all right? We need to think about it as probabilities. If you're thinking about it with money and how much money you lost the last time and you're not going to do it again this time, you are going to have a rough row to hoe ahead of you. You have to think about it as the probabilities beat me on that first one. The probabilities are probably back into my favor at this point. And you can see if you would have stayed consistent with it, your probabilities were very good. You would have done very well. This was the only time in the last 52 weeks that really got above that gold line, which would have been something that I would have been very concerned about on any trade as well. But again, broke above their setup candle and then confirmation right next to it, right? Would have been an opportunity to get involved as well. A bullish trend, what happens? It can break down. We had a setup candle there, and by the end of the day, it broke down below, and you can see it's trending sideways. But usually when we break outside finally from those trend channels, we just don't go anywhere, because the idea is we're a little undervalued now. It feels like you're a little undervalued in these, and it'll have a tendency to trade a little bit sideways there. So keep that in mind as well when they break out of these trends. We saw that over there in the IBM example as well, where once it broke out, it did do a little bit of consolidating after that breakout move. So keep that in mind as well. When it's following a trend very well, it breaks out. It doesn't usually just free fall. What it does is it breaks out of that trend and starts consolidating for a little bit, all right? So a little bit of review. How do we swing trade? Identify the trend, right? That's that overarching move from, however long back you're looking. I usually look back a year, but that's that overarching move. Is it bullish? Is it bearish? Or is it market negative or bearish? And then we're going to be trying to find those support and resistances. Where does it hit on the upside and the downsides, right? Again, you're going to look for those support and resistances by blurring your eyes and trying to see those things in between it. Find the resistance, find the support. Hopefully that's where those lines are. And then finally, we're basing the trade on the pattern. Now in this pop or drop, it's going to be a little bit different because there's no real pattern that shows a pop or a drop other than you'll start getting those counter opposing dojis back and forth that we had talked about a moment ago, where if you start seeing, especially after the underlying starts making moves and then settles down a little bit, and then you start getting candles that look like this, and they might even be some green ones in there that they start changing the color on to go green, and so you start getting all those candles that I talked about kind of lining up, and they might be doing stuff like that, right? So all of those start banging back and forth. It usually means those bulls and the bears are banging heads, and somebody's going to win. It's who's the weak hand? We don't know yet, but we see these guys battling out. We're just waiting for the knockout punch, and that's when the things will pop or drop, all right? So always keep that in mind. When you see that consolidation and it's popping back and forth, I talk about it in my spot in the trades videos. It's like you're old balsa wood airplanes where it's got a rubber band attached to a propeller and you're cranking that propeller more and more and more. Well, the longer you crank that propeller, the more energy you build up inside of that rubber band. So when you release it, if it's built up a lot of energy, what does it do? It snaps really fast. If you only wound it up a couple of times, it's just kind of like, brrr. All right. So very similar in nature to what's going on with the stocks. The longer we see that and the tighter it gets, it's kind of like the Bollinger Bands will start widening out. And because the Bollinger Bands are kind of on the same theory, you can't stay tight that long. It's got to break out. The longer and longer it goes, those Bollinger Bands will start splitting out. Now, people ask me, why don't you trade Bollinger Bands? Because they're hindsight. I can see what the market is doing during that time. If the market consolidates and gets really tight, well, folks, that means the Bollinger Bands are getting tight, and they're going, the longer and longer they stay tight, they're going to want to splay out. All right. So I would rather go off of my setups than waiting for the Bollinger Bands because it's a little bit too far away. All right. Now, why would we want to use options? Options, for one, you're going to have much better probabilities. So you have better odds. All right. Better odds for sure, or probabilities. Why? Well, I just talked about this a moment ago. Like if we were selling a stock short for one of those swing trades, you're beholden to that price. All right. When we're trading options, yeah, we are somewhat beholden to price, but our strike location is going to be much better, especially when we're selling options. We can get great strike locations on a lot of these trades because when volatility is really high, one, we know our premiums are really expensive, but two, that allows us to get further away from where the underlying is trading. And the expectation is that the volatility will come out of those underlyings, and that will make our trade much better, faster. So if we have better odds, we are going to be able to keep our powder dry. And another thing, folks, to keep your powder dry, think about things again as odds, not money. If you are correlating this stuff to cash or money, or how much you got to make, I got to go out there because I got a vacation I got to pay for, that doesn't work. You are not going to be trading mechanically. You're going to have all this emotion tied into this trade, and you will make mistakes. So better odds means you are going to be able to keep your powder dry, like we used to say on the floor, because you know your risks. You know your risks, which will allow you to stay mechanical. If I know my risk, I know my reward, I don't have a whole lot of other things to worry about right now, right? If you start second guessing yourself. You aren't mechanical anymore. Everything starts breaking down. What I want you guys to be like are machines. You think, all right, probabilities, it's got to be this. If its volatility is extremely high, I need to think of a strategy where I can collect a credit and benefit from that. All right. So those are all the things we're going to be talking about. You're also going to have lower margins. All right. That means how much money you have to put up for one of these trades. Now, I don't even know what kind of trade would benefit from a pop or drop where you really don't have a good idea as to what direction it's going to go, because a stock, you're either getting long or getting short. And yeah, you could do something where you do a covered call and stuff like that, but that doesn't really help you on the downside a ton. Well, with options, we can take advantage of scenarios we might not otherwise be able to in the other stocks. So we have more opportunities, if you will. Opportunities. All right. You're going to have more opportunities to get involved in these trades. All right. And you know, most importantly, you're going to know your risk, and it will keep you mechanical. All right. So in this case, the advantage is strike location. As a matter of fact, we had talked about this time and time again. We were selling calls up here at this elevated, when we were around this area, because the volatility was so high, we were able to sell some calls up here. Yeah, don't get me wrong. It was very close to my one, I think 38 calls in this is what we had that we were short. Came up close, didn't quite get there. Market rolled back over, volatility came out, and we were able to get out of this trade. But again, here with this SPY, we had volatility. I think it was right around this area where we had this volatility, and I was expecting us to continue with this bounce, because if you remember in that one where I was like, where could this go wrong? There was a bit of a candle that was a setup for a bullish move there, but at the end of the day, the market slid down. Having said that, we had high volatility going into this day right there. And I was able to sell some puts down here, selling puts at the I think it was the 415 or the 418 strike. I'm drawing a blank right now, but I think it was the 415 strike, which was very close to that point of control. And my whole theory was in the spotting the trade videos that I do every day. And if you guys aren't participating in those, make sure you smash the subscribe button. And right next to it is a bell. The bell will tell you when I come on unannounced. Those spotting the trades, I pop in when I spot a trade. So I can't really nail down the time that I'm going to do that. So make sure you guys get a notification so that you guys can check that out. And smash the like button. That feeds those bots. Okay. All right. So able to sell this. So even though it did break down and trend sideways and maybe even a little bit lower, the beauty in it is that because I set the strategy up properly at the very beginning, that's one of the few things we can do, folks, in order to set ourselves up for success, is setting these strategies up correctly. And that means when you're selling options, you need to make sure that those options are super expensive. And I'm about ready to show you how we get to that. I'm almost there. All right. So let's look at our example that I'm looking at. Again, we've gotten a big move up here to the upside. We got some of those sideways consolidation patterns. I don't have my pen up, so it's not letting me do anything. But you can see when we get those dojis like that, we don't ever know if that's a top or a bottom, but we know that the market is getting a little bit jiggy. And again, so it pops, all right, starting to break into that same type of thing. Now, we've had a big move. So my whole thing with ConocoPhillips and oil's, it's kind of rallying with oil. We've seen oil bounce up into the 80s. Now, a lot of folks are calling for $90 or $100 even, let's say $100 oil. If we pop to $100 oil, I won't be surprised. That's only because of inflation. I don't think there's demand behind this rally in crude oil. And I talk about the reasons why when I talk about the economic data and those spot the trades. So I'm not going to go into nauseum about that here. But I do believe crude oil is overpriced. I think crude oil is going to come down. But one thing I've learned in crude oil is if you want to trade crude oil, you better love to lose money before getting involved in that. All right. And the reason why is because it just, I'll be honest, doesn't make sense 90% of the time. It does not follow along with what we would normally associate to the levers and pulleys of the economy. All right. We can see crude oil inventories ratchet up dramatically and still see crude oil move higher. That doesn't make sense to me. You see supplies going higher, lack of demand. That means price should come down. Oil doesn't always do that. So with that said, I have an assumption that I believe crude oil is going to come back down. That's going to hurt some of these oil companies. They should see their price start to fall as well. Having said that, I might very well be completely off my rocker and not even know what I'm talking about. And we could see crude oil blast off to 100. If that happens, ConocoPhillips going to do the same. All right. So we've gotten to the point where I am expecting a big move. ConocoPhillips could shoot to the upside. And if we see it crack down, since we are so far overextended already from value, what the market perceives as value, if these folks start to cover those trades, we'll see it come back down towards the point of control right here, which is where the most time and volume has been spent. Reason why I say that's where the market or we are overextended in value to the upside. Well, this is where the market perceives value, is right there at 55.45. So if a market perceives value at $55 and we're $20 higher than that, that is significant, especially when people are looking at their P&L and thinking about money. I need to cash out because I got to pay for this vacation. Wrong mindset. Forget that. It's probabilities. All right. So now that we got the swing trade idea going, right? We understand. We've gotten our bullish trend. We've checked out how we can figure out pattern reversals with this one. This isn't really a pattern reversal, but this is a messy pattern. And those messy patterns usually result in big moves because, like I said, we have some heavy battling going on between the bulls and the bears right now. And one of them is going to win. We just don't know who yet. All right. So we understand we want to use options because of better probabilities, better risk reward. And the allows us to stay mechanical. David's asking, John David's asking, what is the blue line? Is it the simple moving average? It is the simple moving average. This blue line here is the 50-day simple moving average right there. In some charts, I throw in the 200-day simple moving average and stuff like that, but that's usually if we see a correction. If I don't have to worry about the 50-day crossing over the 200-day, then I usually don't even have it on there. And usually what that indicates is a longer duration trend reversal. If you start seeing those crossover, the 50-day crosses over the top of the 200-day, then usually what that means is that it's a bullish trend. When the 50-day drops below, then that starts becoming a bearish, longer term bearish trend. Good question though. So what are options? First off, let's think about it from the call buyer side because it's kind of like math. Multiplication is easier than division. So options is, in options terms, calls are the multiplication, I guess. So calls give the buyer of that option the right, but not the obligation to buy the stock. So if I buy a call, and for instance, the underlying is trading, I've been using this example, so I'm going to stick with it. XYZ is trading $100, right? And if I go out and buy a call at the 105 strike, okay, that's higher than where we're currently trading, obviously, right? So the call buyer, during the life of this option, sometimes it's Nov, Dec, Jan, Feb, any of those months. Right? That doesn't really matter. During the life of whatever this XYZ long call option is, all right? So 105 calls. If I buy this and let's say pay $1 for it, I have to pay a premium for the right to hold this contract, okay? Now the seller gets to keep that premium. We'll talk about that in a moment here. But if I'm buying the 105 strike and XYZ is trading 100, my call gives me the right to buy XYZ stock at $105, right? But XYZ is trading 100. Do I want to exercise my right to buy XYZ at 105? When in fact, right now it's trading 100? No, nobody would do that. Why? Because I can go out there and buy it at 100 right now and not pay 105. Even if I paid $1 for that 105 strike, it's still saving me money to forget about that call and buy the underlying outright, okay? If this underlying then, during the life of my option, I bought it at I bought the 105 strike for $1. Now, let's say 2 weeks later or something, XYZ is trading 195. Now, do I want to exercise my right to buy the stock at 105? It's trading 195. Yeah, there's an immense value in buying something $90 lower, right? That would go into my P&L. You're up on this trade $90. All right. It won't take into account that you lost $1 or you paid $1 for that. You did kind of lose that $1, but you made up for it in this move to the upside. So this stock or this strike that I paid $1 for, I bought this call, 105 call for $1. Well, right now it has to at least be worth $90 because it has to include the benefit between my strike and where it's trading. Okay, everybody follow me so far? Feel free to throw it over there in the comments section if I've lost you on any of this math so far. I'll be happy to talk back and forth with you. But there's probably going to be a little bit of extra money. This is the benefit. That's the intrinsic value. That's the real value of this strike. But there's also going to be some time decay or some theta, maybe even volatility pumping this premium up. So this is probably trading somewhere around 91 or $90.50, let's say. So we wouldn't want to go through that assignment process because that costs a lot of money. I suggest you guys go out there, just get out of your call, sell your call for that $90+, and then go out there and buy this stock. The reason why is because you're going to save money on the commissions. You don't have to pay anything for buying a stock these days. The commissions on trading out of the option are much less than the assignment process. And if you were to go through the assignment process, you leave off, you would capture that $90 of intrinsic value because it goes over to your P&L at 105 and it's trading 95 right now. It's going to show you're up $90. But it will not give you that extra 50 cents on the contract, that theta, that extra money that is over and above the benefit you should have. All right. It's called theta or time decay. So that 50 cents times 100 is $50. You're leaving $50 on the table and paying probably like $35 to go through the assignment process. All right. If I just got out of the stock or out of the strike, then I would have gotten to keep all that. All right. I would be ahead of the game by $50 because that would have gone into my account. Everybody following me there? All right. So the call seller has the obligation then to deliver the stock. All right. If you don't have the stock, then it's going to be you're short and you're going to have to borrow that stock. But the seller of the stock seller of the option has the obligation. So if anybody says that if they're the buyer and they say, yes, I want to go through the assignment process with you, the call seller has no say about it whatsoever. It happens. Okay. You would have to sell that stock. The put buyer has the right but not the obligation to sell the stock. So a lot of times we associate this when we have a stock, we buy insurance and that's buying that put. In case the underlying falls below where we are, then our put can be offset. We go through the assignment process and say, you know what? Those stock are yours at this strike price. Again, don't go through the assignment process. The same thing with the calls is going to happen with the puts. You're going to have to pay for the assignment process and you're going to leave money on the table from theta decay. Yes, you will get all the money from the benefit. You're never, ever, ever going to lose that. That's part of the contract. It has to include the benefit. All right. So the call buyer has the right, but not the obligation. And keep in mind, if you are a buyer of an option and you go through the last day of expiration, if that stock has intrinsic value, meaning there's a benefit to owning that, they are going to automatically assign those stock. All right. So you are going to have to pay for the assignment process. All right, if you are long that stock. And if you're short the stock, the same thing. If it's in the money, you're going to go through the assignment process. So any option in the money goes through the assignment process if you don't do anything before expiration. So the call buyer can sell that stock, the call buyer can sell that stock at that strike price. The call or the put seller has the obligation to buy it at whatever strike. So in this case, if we were looking at that like 95 strike just below and the underlying fell to 0, well, this 95 strike would then be the one in question, right? If you sold that, you would have to buy the stock at 95. Makes sense for everybody so far? Cool. All right. Now, we've heard about pricing, right? Call buyers pay a premium. Call sellers get to collect that premium. Now, once that transfer happens, everybody is out it unless you offset that trade. But what we need to determine is that price that we're paying for this option or selling this option for, are they expensive or are they cheap? So we need to go over the option montage page, which is this page in particular is what I call this page, the montage, for lack of a better way to say it. And this tells us a lot of different things. One, it's going to tell us whether or not our prices are expensive or cheap in a two-part step, okay? Am I sharing? Yeah, I am sharing. So what we need to do is look at volatility on the option montage page. Does anybody know where you can find volatility on this option montage page out there? Vega, that's right. Vega is the one where we look for implied volatility, really, to be more specific, is what it is. On this page, they call it Vega. Why? I'd rather you to just kind of be cheeky and keep all of these things in the Greek category, even though Vega is not a Greek. But what they tried to do is keep those things in unison or something. I don't know. Being cheeky. But anyway, Vega is what we're looking for because that's volatility. That is the option montage's way of saying volatility. And we need to know what these numbers are right here. All of these things are in percents, right? Well, what that tells us is the implied volatility for ConocoPhillips, all right? So we aren't looking at it as just 32, all right? What we're looking at it as is 32 in relation to what ConocoPhillips usually is. Is 32 high or is 32 low? I don't know yet from looking at this page. Nobody can really tell from this page unless you trade it every single day. But something to note, 32 being a number, just a number, know that something like Tesla probably never gets down to this level. So that's why I want you to compare apples to apples, meaning I want you to compare ConocoPhillips implied volatility to ConocoPhillips implied volatility. So we need to look at Vega. Now, one thing I'm going to back up just really quickly. See all of these numbers associated in these columns? They're associated to the Greeks. Well, because the Greeks will tell us on the calls and the puts, we can look at the calls over here too. They're the same, Theta and Vega. So all of these Greeks assume a forward advancement, if you will, of 1, okay? So what I mean by that is if ConocoPhillips moves up by $1, then all of our premiums will adjust by the corresponding coefficient. Meaning if it moves up by $1, our calls and puts will be adjusted accordingly. Notice the puts are negative because when the market moves higher, our premiums go down on the put side. Now, if the underlying goes down, we have to add a negative plus a positive, and then that happens, right? So if the underlying went down, a negative move plus a positive delta makes that a negative delta, right? Does everybody follow me there? Or a negative move on the underlying plus a positive or a negative delta, a negative move plus a negative delta makes that a positive delta. Okay, so it would add in if we started moving down. Theta is 1 day goes by. Vega is 1 percentage point higher. And if percentage points start going negative, remember we got to add that negative to our premiums or our coefficients, I should say. So ultimately, you go to the spot month, and that's the one that has the most time and volume, or the one that has the most volume, I should say, not time, the most volume going on. That's usually that one that's right around 35 days to expiration. That's what we call the spot month. That's where everybody is generally trading. I'm not talking about you and I, folks. I'm talking about all the other folks that really don't understand. I'm only selling options in those front months, and I'm buying options further out. Why? Because if we take a look at the theta, you can see theta is much less. Theta is time, much less further out in time than it is in the near duration options. You can see theta is really pretty big right in here. 13, 14, not very much out here, okay, on both the calls and in the puts on the theta, sorry. Theta is much greater near duration, all right? Any questions so far? I don't see anybody. So with this one, I'm looking at the pop or drop, and I have a chart down here at the bottom that is implied volatility. And I would suggest anybody out there get this try and find an implied volatility chart in your platform. Thinkorswim is just IMPVOL and you'll find it. Other platforms I'm not so sure about. But we want this implied volatility because we can see that it doesn't look very great here, but we will know that they stay within a pretty good range. We can see that the low, and I like to discount anything in the last 6 months because I just don't think we're going to see that kind of volatility anytime real soon. So I want to discount that from my thinking. So this is basically the high and the low and where we currently are, all right, in relation to that high and low range. So let's zoom in on it actually and make it a little bit easier. And we can see that we've got our high here and our low, and we are literally at the new low here. So what does that tell us? Just by looking at that, I can see that implied volatility is at the lowest level that I've seen all year. What does that mean? That means if volatility moves up and down and those prices fluctuate based on volatility, every percentage point up or down, it affects our premiums by the coefficient. Last 52 weeks, folks, we haven't been this low. That means to me, they are incredibly cheap. I mean, we're talking bargain basement, five below kind of stuff. So in that, with the volatility being this low, I have to believe that volatility needs to start moving higher, right? Just based on historical context, it wants to stay within these ranges. Somewhere between 30 and probably 55 is really the major historical range. You know, mine's a little bit higher than that, but we're in unprecedented times. But I do expect this volatility to start going higher. Therefore, I believe they're really cheap, all right? This tells me the premiums across the board in ConocoPhillips are super cheap. But if you are like an actuarial scientist or something like that, and you need to know the devil of the details, well, here you go. This is how we determine implied volatility percent. Now, I have the script that discounts all of this. Thinkorswim will add that stuff in. I don't want it, so I'm discounting it. But what we do is take the current implied volatility, current IV minus the low IV, and really all we're trying to do is get where we currently are off of the low. And then we take that and divide it by the high minus the low. Sorry if I'm screaming in your ears right now. I got a mic right in front of my face. All right. So we try and find out where we are off of the low by this top part of the equation, the numerator, right? And then the denominator tells us what the entire range is for this. So having said that, I go with the current is at 31. What's the low? Well, it's 31. The high is going to be 58, low 31. So basically we got 0 over 27, and that is 0. So we are at the lowest we've seen in the last 52 weeks. Now, get me, I didn't have to go through the math to figure that one out for you guys, right? You guys probably already had that figured out. But it's not always at that lowest level. It usually is usually a little off that. If you can find it at that lowest level, you know that's the time to strike while the iron's hot, which is why I usually wait for putting on the trades till Friday, but I found this trade a couple of days ago, and I didn't want to wait in case stuff started getting jiggy. So I did put this trade on a little bit earlier. All right, but back to that volatility thing, we know premiums are cheap, right? They're at the lowest level we've seen. So if premiums are cheap, what do we want to do? Buy options. All right, now, we know we want to buy options because they're cheap. We've looked over there at the option Montage. We can tell by Vega or implied volatility and going through the math or just looking at a chart and kind of eyeballing it. They're super cheap. So we want to buy options. Now, if you want to buy something and you're trading options, you need to worry about this guy called Theta. He's the thief in the night, all right? Theta's negative on both the calls and the puts because it's time, all right? You can't go back in time, so time is always eroding our premiums. We used to call Theta the thief in the night that comes and steals your premiums. So if that helps you remember some of these Greeks, you know, delta is data. Theta is the thief, all right? Vega is volatility. If any of those things have helped you out and made that light bulb go off, please smash that like button and share that information out there because you're feeding the bots to find somebody to look like you. All right, so what we do is we go over here, and this shows us that Theta is not linear. Remember, I showed you a brief snapshot in the option montage on a real life example before I got to the simple concept, I guess. But we saw that that Theta increased the closer and closer we got to expiration. It's not linear. It starts out at like a penny, and then it's 2 pennies, and then it's 5 pennies, and then it's a dime, and then it's 2 nickels. Or sorry, then it's a dime, and then it's 2 nickels. No, then it's a dime, then it's a quarter. All right. So what happens is we can see inside of this 35 days to expiration, and I like to say basically 45 days to expiration is really the sweet spot here. We can see how much Theta erodes from those premiums. So even if the underlying didn't go anywhere, you would be wanting to sell those options in this front month because you would see those premiums go down. Now, do I want to buy anything that has the most erosion going on? No, I want to limit that if I buy it. So I want to go out in time. Now, I don't go 300 days out. Those are going to be really expensive. And yes, we are getting more expensive the further out we go. But if you buy something for $7 and it only erodes by a penny, versus buying something for $3 and it erodes by 25 cents every day, where would you rather put your money, right? So this is where I say is the buy zone, and this is where we look to say is then the sell zone. So you want to sell inside of 45 days to expiration is kind of the sweet spot, and buy, I like to say outside of 70 days is the buy zone. All right. Because if you can get in there into a trade just outside of like 70, 80 days to expiration, it's really by the time you get to 40 days, that Theta hasn't really started picking up a whole lot. It's increasing slowly, but once you get inside of this 45 days, that's when you can see we start getting that massive drop. So for one, I want to get out in time, limit that Theta decay, and then during the overall life of what I think I'm going to be holding on to this option, that Theta decay is not ratcheting up very quickly. It will ratchet up, but it's not going to ratchet up as quickly as we would see inside of here. So Theta, that thief in the night, this is an example of like SPY. Look at this, with just a couple of days to expiration. We got 2 days to expiration. Look how much Theta is coming out of this premium. Almost 50 cents. A third of the premium is going to be wiped out tomorrow, even if it doesn't move a penny. All right, let's look at it way out here in time. So we're going to be looking at something like, let's just go from like 128 days. 28 days rallying in. We can see that these premiums only increased by 1 penny over those 28 days. But if we looked at these 28 days from here, or 35 days, which is more obviously, but look how much increase we saw happen to those premiums. 30 days to almost, right around 30 days. Close as we can get really to comparing apples to apples. So you obviously would not want to be buying with this much Theta decay anyway, for the most part, but to buy the premiums for, less, excuse me, and then have that kind of Theta decay happen when the underlying doesn't move is not a very good strategy. We want to get further out in time, limit that Theta decay. Yeah, you're going to spend a little bit more up front, but if you can be a good steward of your capital and limit that erosion, then you're doing it as good as you can. Now, ConocoPhillips, again, similar situation. I want to just take a look at what happens to our Theta as we get closer and closer to expiration. We're out looking at that out past 70 days to expiration. Couldn't quite get there right there. But inside, we're moving close to 30 days there. And we've got right around 30 days, 1 penny increase. These 30 days, massive increase in theta. All right. So low premiums is indicative of low volatility. That means we got to buy, all right? Or we got to think to buy. I don't want to be selling option premiums when they're the cheapest I've ever seen, right? Likelihood is it's going to bounce up. I've sold something cheap. I don't want to do that. So with theta, we can see that the theta ramps up there as well. Now, I've gotten this, right? Cheap, it's basically a pop or drop. I need both scenarios. That is the long strangle. The strangle is buying an out-of-the-money call and, I don't know what I did there, an out-of-the-money call and an out-of-the-money put. So that's a delta thing. Delta, everybody says, tells you the rate of change to the underlying for every dollar move. All right, we've already gone over that. That's pretty easy, right? Option Montage, the Greeks are an advancement of 1. Well, that's an advancement of $1. Our premiums would increase to that corresponding coefficient, right, over there in delta. Calls will increase on a move up of 1. Puts will decrease because it's got a negative number there. But what I want you to guys walk away from delta is data, all right? Not just that dollar move and how it affects my premiums. Yes, you do need to know that, but to be honest, these other things that delta tells us are much more important than telling me the rate of change in my premiums, in my opinion. But delta tells us it tells us the probabilities of being in the money. All right. So if it's a 16 delta, that means at expiration, the life of this option is going to be done after today, that option has a percentage of being in the money by 1 penny. All right. So a 36 delta, that strike has a 36% chance of being 1 penny in the money. Okay. Same with the deltas on the negatives, because if we go down, those negatives become positive. So it's still the same probabilities of the out of the money ones. And the in the money ones, like if it's an 84% probability or an 84 delta, guess what, folks? It's in the money already, and it's got an 84% chance of staying in the money by 1 penny. Okay. But delta tells us that probability of being in the money, and 2 times the delta is the probability of touch. Okay. And what that means really, folks, is 2 times the delta. If I'm looking at like a 36 delta, 2 times that delta means that I have a 72% chance of the underlying during the life of the option contract comes up and trades my strike. Okay. So if I had on a 59 strike, that means I see 59's trade, 59 evens trade. Okay. 1 time. That is the probability of touch, 2 times the delta, which is really important as an options trader because we are playing the probabilities. That's what I want you guys to focus on in these videos in staying mechanical, is that you need to know the probabilities, because that will help you stay mechanical. And the probability of touch being 2 times higher than the probability of being in the money, well, listen, folks, I'm playing the probabilities. I get that sucker to come up and hit my strike. That's probably where I'm pulling the ripcord. Now, if it rips through the strike, and blows through it and never looks back, then I know I need to get out when it comes back down to my strike, but, look to cover that trade. I look to cover it when I get hit, all right? Or you could look for a 50% increase in the premiums, which is probably going to be very close to the same thing. All right, we ready for the strikes? Well, I'm going to do around a 36 delta. And it's ish because every time you go over to the option montage, folks, you don't see an exact 36 delta. But the idea is what we're trying to figure out here is a 36 delta is a half a standard deviation. These you could say are the put side. We've got the call side just because of positive and negative, kind of thinking about it as deltas because believe it or not, folks, deltas just the probabilities of being in the money by 1 penny, well, that correlates to a standard deviation curve. So 36 delta is a half a standard deviation. Up 16 delta is about a 1 standard deviation move. All right. So we want higher probabilities, right? Because I'm buying an option. I want low probabilities when I'm selling an option. When I'm buying an option, I want to go win the money. So I'm going to try and pick something that's very close. That's what we call the 36 delta call or the 36 delta put. Now, how do I come up with 36? Well, if I add 15, 9, 4.4, 1.7, half, 1, and there's a 4th standard deviation, 5th standard deviation all the way up. Basically, when you add up all of this, it adds up to around a 36. And all of this adds up to around 36. All right. So when you're thinking about standard deviations and probabilities here, what we know is if we're doing a 36 delta, if we add these two probabilities up, we have a 72% chance of this happening or this happening, right? It's a total of 72%. It can move in one direction or the other, but pretty good 72% chance that I'm going to finish at least one side in the money by a penny, and only about a 38% really, if I'm going to do the math right to make it 100%, 38% chance of this happening then. Okay. Pretty low probability of it staying right here. Probabilities are the probabilities. So I would want to do it when I'm building it out as a long to try and encapsulate 76% probability, higher chance of success. So 36% probability is what I'm looking at. And that is ish, folks, ish. It's not always going to give you a 36 delta. All right. If you want to be a little bit more aggressive, then you're going to go closer to the 40 delta. You're going to get a little bit tighter, increase your probabilities, right? You want a little bit of less aggressive, maybe risk less money. Just know if you're risking less money, you have lower probabilities of success. Then maybe you're going to go out closer to a 20 delta or something like that. Why do I like the 36 delta? For one, I have a 72% probability at expiration of being at least 1 penny in the money. Good probabilities. The other thing I like about this 36 delta, remember my 2 times the touch, 2 times the delta equals the touch. Well, that means I have a really good probability of it trading. I have 72% probability of it trading my put strike and a 72% probability of it trading my call strike. Now, what do you do with this one? This is one of those few trades that I would try to leg out of. I'm not going to cover the whole thing usually right off the bat. If it goes up there and hits my short call, that's the one I'm covering. That's the winner. My long put, well, you know, it's probably pretty much lost all its value already off this rally. So why not just leave that one on there? If the market free falls or there's some kind of crazy black swan event, well, that might go in the money. All right. So there's no real reason to take it off when it's a long or a short, or sorry, a long put or a long call, because, you know, it's just kind of like a free option at that point to just leave it on. I mean, to collect $5 for it or a nickel or something is just really not worth it to me. So that 36 delta. So let's drill down on an example here. You can see on the, on the put side, the 70 strike is a negative 33 delta. It's still a 33 delta. It's not that 36 delta. And I didn't want to get so tight as to get to that 41 delta, because I would have been like right on top of these strikes. So you can see it was trading right around 75, equal distance, $5 down, $5 up. Selling that strike, it's a 34 delta. So very still close to that 36 delta. I opted to go slightly further out and away than closer, okay? Just in this example, sometimes I will go a little bit tighter, all right? But just for this one, I decided those strikes were a little bit better, and I hate doing half strikes, to be honest. How do you get 72%? Shouldn't it be 64%? Hold on a second, I'll go back to it. What was I going to say? So basically going equal distance away, $5.45. Now, a lot of you got folks are probably going, dude, you always give us a pretty good breakdown of how much we should spend versus our risk reward. Well, the long straddle and the short straddle, it's really hard to come up with a percentage. It should be less than probably 10%, which will almost always happen. It's just a product of these deltas and stuff. So really what we're doing is trying to get the cheapest premiums we can. We can't always determine exactly what that premium would be and whether or not $5.45 for this strangle is egregious. Well, we know that those premiums are super cheap, so we know we have to be buying it as cheap as it could. Going back to let's go back to the standard deviation curve real quick. So if we're adding up 36 and 36, that means the underlying can go up here or down there. So the likelihood that it stays right here in this middle, if we add these up, it says it's basically a 38.2% probability of that. So that means everything else is a 72%. Does that sound better that way? But during the life of this option, the underlying could come up and trade this 36 delta. That's a 72% probability. If these numbers are kind of correlating, it's really only due to the fact that I picked 36 and 72 it's just kind of working out that way. It doesn't always do that. But 2 times the delta is the probability of touch, right? Of pot, I guess. I've never done that as an acronym. I guess that's what it is. Anyway, so there's a 32% or 72% probability that it'll trade that strike and a 72% chance that it'll trade that strike. It means it can go up and hit the calls and hit the puts all during the life of that contract, right? That's why I'm saying if you can, we're not talking about 110%. You're right. You are absolutely right. John David says, dude, stop doing math in your head. You're right. I'm sorry. It is a 62%. That is a 62%, but it's 36 times 2, still 72. Yeah, that one I did do right? I got that one right. Ooh, throw a party. Thank you very much, though, for correcting me on that. I do appreciate that. And folks, John David's all over this. How did you guys not know? But hey, that's an example of, folks, if you have a question, you see me misspeak, I do have a tendency to get ahead of myself and misspeak. Please throw it over there to help everybody else out. I don't want to derail everybody. So comment throughout the video. All right. And smash the like button. Okay, so we got our strikes. We're going for about that 36 delta, and then we can see what our risk reward is. We know when we are buying an option that is as much as we can lose. Anytime you pay for an option because you have the right and not the obligation, you know what your risk is. The seller, not so much, all right? But in this case, we are the buyer of an option. So we can see we've got our 80 strikes. So this is our 80 strike right here, our 70 strike. And if it stays in between here by expiration, we're going to lose both sides of that. During the life of it, what we have to do is we have to add this $54 or $5.54. So plus $5.54 is to our break even. So really that's going to be lining up at around $85.54. To the put side, we have to subtract that debit to get our break even, because we have that long. What has to happen is this long put that we own has to make a move enough to cover that debit we paid. So in that case, we'd be looking at 60, what is that? $64.46. 64, what did we have? 64.55 is the break even to the downside. I love it. All right, so that's how you figure out your break evens, especially with that debit. You gotta make up for that move. Now that's at expiration. These profit, the analyze tabs, I do it just for you guys because it really gives you a pretty good idea of that range there. But at the end of the day, if volatility starts going through the roof here right away, this purple line would start coming up to a bigger happy face there, and it would start moving higher. Because think about it. If the underlying doesn't move, but our volatility goes higher, well, all of the premiums go higher with that volatility ratcheting up. So the underlying doesn't even have to move in this scenario if we got volatility to spike. Now, that doesn't always happen. It will happen on rare occasions where we'll see volatility spike and the underlying not moving. And that's where you would start seeing yourself make money right away. Or it makes a big move quickly and there's no theta decay. You would see yourself getting to profitability faster. But more so, we want that volatility to start spiking. As a matter of fact, you can see that I took that shot. Must have got rid of my thing. There it is. You can see I took that screenshot a couple of days ago when we were down there at those low levels at 31, and it's already increased by 1 percentage point. So if I were to look at my option montage again on that 1 percentage point move, well, we can see if volatility increases by 1 percentage point, going from basically, well, this looks like it's gone up a few percentage points here. But if it were to go up by 1 percentage point, that means that this 14 cents right there goes into the premiums on the call or on the puts and in the calls. So 1 percentage point move higher for this strategy, it increases by both sides because volatility increases the premium. So this would increase by 14 cents there. That would go in there. 14-cent winner, even if the underlying doesn't move, 15 cents goes in there as well. Actually, I'd probably have to look at my strikes. I needed to look at my strikes first, 80 and 14. So basically 14 cents, a total of 28 cents going into my overall strategy just by that 1 percentage point move higher. Okay, the underlying, we could assume didn't move a penny. Just 1 percentage point move higher. My strategy would increase by that 28 cents. All right, or $28 multiplied by the contract multiplier. Because remember, every single option contract is equivalent to 100 of the underlying. One option contract has 100 of the underlying in it. Okay. So that's why every time you do this, you're like thinking, oh, I paid $2.90. I can throw that away on a Starbucks. Once you do the 100 option contract multiplier and then it turns it into 300, well, you buy a lot of them. So keep that in mind. $28 went into that premium basically overnight. Because if I were to look at the actual chart, I think it looks like it only increased by 1 percentage point. Okay. How do you tell volatility spiking when you are on a trade already if the implied volatility only shows you the daily implied volatility? How do you know volatility is spiked? That is a good question. Alina, unfortunately, what I do, and covered it up with your question, is have this chart down there. Now, if your platform doesn't provide that type of chart, if you don't have Thinkorswim, I would actually call them and ask them how you get implied volatility or Vega, and you want to chart Vega. Okay? Because otherwise you wouldn't know. If you're just looking at a number, you need to take that number and put it into context with what this underlying's done in the past. Okay? And with this, I talk about when do I get out? Well, if this is set up on, a candle or something like that, I would get out if that pattern's broken. But with this one, we're looking for a snap on a pattern. So when would I get out on this? If the underlying doesn't move and I just see this premium start to go down, maybe 50% of what I paid for it. So I paid $5.45, so right around 250 or something like that, 250, 270 something, would be where I'd look to get out on a loser if I had a low risk tolerant appetite. I have a high risk tolerant, so this is one of those things I'm going to throw in there and I'll let it ride. All right. If it goes up and hits my calls, I'm going to cover the calls. I'll leave the puts on. They're probably almost worthless anyway. If it goes down and hits the puts first, I'll cover those, leave the calls on. If it pings back and forth, dude, you guys, those are great problems to have. Legging out of that thing like a genius would be awesome. And if you do, please write me. I'll use you as an example. All right. So that's what we're looking at for getting out. Try and leg out of it. It hits your calls. You beat the probabilities. Roll it. Okay. Play with those things. All right. Before you go, subscribe, hit the bell so that you guys get notification on my Spot the Trade videos. That's when I go in during the day and I talk about trades that I'm talking about the markets, talk about the trades I find. So make sure you take advantage of that. Click on this link in the chat window. Let me get it over there real quick. Make sure I still have the right one. Looks to be good. And you can click on that hot link in the chat window. Will take you to this 15 hours of content. One thing, you guys, seriously, now everybody's talking about it. Higher interest rates are going to decimate, folks. I'm telling you, we've had interest rates so low for so long that people are going to get really hurt. The average person holds a bond for 7 years. A bond is 30 years. So you're never holding it to the life of the bond. All right. So with a product of trading bonds or buying bonds and selling bonds is you buy a bond and you hope to get back par value when it expires. Okay. And you will. But during the life of that bond, I talk about the teeter-totter effect. All right. If interest rates, or let's say if bonds go down in value, that's because that pushes interest rates higher. Now, we always hear it from the TV that interest rates are going higher. Well, if interest rates are going higher, that means the price of those bonds are going lower because nobody wants to buy your 0.5% bond. They'd rather go out there when interest rates start rising and buy a bond that has a bigger coupon. So they're willing to pay more for a bond that pays them a higher coupon rate. All right. And if you keep doing that, if interest rates keep rising, you keep playing that game and you're buying high and selling low. How do you counteract that problem? With an ETF, a bond ETF? No, those guys are even worse at it than anybody else. Those guys are in and out all day long. They're trying to make money on commission. So they're in and out buying high and selling low all day long. So I can't see an ETF making a whole lot of money either. So you have an IRA, if you have a 401k, if you have a financial advisor, I would suggest you talk to him about that type of risk and how you don't want to get that bond portfolio decimated. And I show you in this video on how to trade markets around rising interest rates right there. That could be the most important thing you ever learn going forward for the next 3 years. There's nobody that's had to worry about this in the last 10 years, but I guarantee you there are so many folks out there that have had a portfolio created during these low interest rate environments. And if you have a financial advisor and you are 40 years old, you probably have 30 to 40% of your portfolio in bonds. If you're 60 years old, you probably have 60% of your portfolio in bonds. All right. And if you want to see that part of your portfolio get decimated, then don't do anything. If you don't want that to happen, watch how to protect your portfolio against rising interest rates. It is more dramatic than what you think. I guarantee you it will open your eyes. Best time and place to for the strangle. A best time and place for a strangle is when, you're going to have the assumption that you have, like with me, I believe that crude oil is going to come off. I think that these oil companies are overvalued. But I know that oil is going to try and hurt as many people as it can, right? And never really follow suit. So I'm worried about it actually bucking conventional wisdom and blowing off to 100 when we're seeing the economy slow. So that's how I came up with my pop or drop. How you come up with a pop or drop is key. Now, why did I settle on the strangle? Because I would say that I'm about 50-50 either way. When we were talking about the butterflies, I was like, all right, this is a lean towards bullishness. And this is the put butterfly. We're like, okay, well, it's a little bit odd, but, we're doing this as a short a short put butterfly. We would be expecting that we would want it to kind of stay right where it's at, but we actually want the short put butterfly to blast off, right? So we lean towards the bullishness and the put butterfly, bearishness on the call butterfly. This one is really a 50-50 toss up for me because I'm about as sure as I'm wrong as I am right. So kind of like that. That's my 50-50 on that. Does that make sense? All right, here again is that link. You guys can punch this into your URL or just kind of flip through the chat window over there. You guys can click on that. It's a hot link that'll take you right to it. So this is that. Thank you guys all. I do appreciate you guys sticking around. Again, comment for those folks that didn't watch this live. I will come back around and make sure you guys are all clear concept. I see somebody else is already coming in. Smash the like button. That helps me out because it feeds all these bots. And the more bots we feed, the better traction we get there. And please smash the like button if it helps you out. That does. Oh, subscribe is what I meant to say. How many hours is this trading video? The one that I just showed on this one here, this is well over 15 hours, and that's just to be kind. It's probably over 20 hours. And the beauty of it is we have the software set up where it's really not a dot, it's a box like these. So if you wanted to go over here and protect that, it'll check it off for you like you've watched it. It'll even show that you've watched partial of it. So you know which ones you've watched, and you can go back and check those out as well. It could go up or down to the prices, John David's saying. Yes, and you're talking about the strangle again, where yes, it could go in either directions. That's that 68% probability that I told you about. But anyway, yeah, that's what we were talking about there. All right. And I want to thank you guys all. I do appreciate you guys all making the content. You guys do drive the content. Your questions, comments, everything else will drive the future content as well. So if you have any ideas for me, throw it out there or reach out to us at trading@protraderstrategies.com. All right. And you can call us too. You'd prefer. There is a real live person there answering. 310-598-6677. All right. That's it, folks. See you next week on Swing Trades, and check out those spot the trade videos in the morning. And the way to do that is make sure that bell is notated that you get all of our hits. So when I'm coming on unannounced, you'll know. Can't take that? Take it easy. Bye for now.